Today we're doing a complete breakdown of ASC 323. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Investments in joint ventures and equity securities were once chaotic, lacking uniformity in financial reporting. With ASC 323, a $10 million investment now follows clear guidelines, enhancing transparency. Understand how this standard ensures consistency, making financial statements more reliable and easier to compare across entities. ASC 323 primarily solves the inconsistencies in accounting for equity investments. Prior to its introduction, companies had varied approaches, leading to incomparable financial statements. ASC 323 establishes guidelines for recognizing and measuring these investments, aligning with the economic substance over form. This means a company with a 25% stake doesn't just report dividends, but also its share of earnings. Entities with significant influence, generally holding 20% to 50% of voting stock, must adhere to ASC 323. Effective since 1995, this standard mandates the equity method for accounting. The core requirement? Adjusting an investment's carrying amount based on the investor's share of the investee's net income. This ensures financial statements reflect the investor's true economic interest. The equity method, central to ASC 323, reflects an investor's stake in an investee's earnings, not just dividends. When a company has significant influence, typically 20 to 50% holdings, the equity method captures its share of earnings, adjusting the investment's value accordingly. For interviews, note this enhances comparability and depicts true financial interests, unlike the cost method, which only records dividends. Scope errors can derail even the most prepared candidate, a classic trap, forgetting that investments measured at fair value fall outside ASC 323's scope. Understanding what is included and excluded can make or break your interview performance. Dive into the specific aspects that ASC 323 addresses and navigate through with confidence. ASC 323 focuses on investments where investors have significant influence, like associates and joint ventures. For example, owning 30% of a company's voting shares falls under this scope, allowing you to use the equity method. Knowing these boundaries ensures accurate financial reporting and compliance. ASC 323 explicitly excludes investments in subsidiaries, which are consolidated instead. For instance, if you own 60% of a company, it's a subsidiary, not just an investee. Fair value investments, often encountered in the market, are also outside this scope. Awareness of these exclusions prevents costly misapplications during financial reporting. An investee is where you hold significant sway, often owning 20 to 50% of the entity. This allows for participation in their key policies. For example, owning 25% of a tech startup makes it an investee, not a subsidiary. You'll then use the equity method to reflect your share of their profits on your balance sheet. Significant influence means you can sway an entity's financial and operating decisions, often with 20 to 50% voting power. Suppose you own 40% of a retail chain, you can influence their major policy shifts. This control is reflected using the equity method, impacting your financial statements in a way that fully captures your economic interest. Navigating edge cases in ASC 323 can be tricky. Consider owning 15% of a business, but having a board seat. Here, significant influence may apply. However, electing fair value for a 30% stake removes it from this standard. A 55% interest in an LLC without control might not fall under ASC 323, despite ownership percentage. Each scenario tests the limits of this standard. How does a company accurately reflect its stake in another business on its financial statements? The equity method model provides the answer. It ensures that significant influence over an investee is properly captured, reflecting true economic relationships. This is crucial when companies make substantial investments, impacting both balance sheets and income statements with precision. The equity method model is vital for investments where significant influence is present. It ensures accurate representation of the company's stake through a structured approach. To illustrate, Consider Meridian Corporation's $10 million investment in Acme Incorporated. This investment includes an $8 million software license and $2 million in implementation services, an ideal scenario to understand the model's impact. Meridian Corporation's initial $10 million investment in Acme Incorporated must be recorded at full cost, which includes $8 million for the software license and $2 million for implementation services. This comprehensive recording ensures accurate financial reporting. A common error is excluding certain costs, which skews financial statements. ASC mandates all direct acquisition costs be included, setting the baseline for future financial entries. With a 30% stake in Acme Incorporated, Meridian Corporation demonstrates significant influence, meeting the typical 20 to 50% ownership criteria. This influence determines the use of the equity method, a critical classification. Candidates often misjudge influence, especially near thresholds, affecting financial treatment. ASC clarifies that beyond percentages, factors like board representation are pivotal, cementing the influence Meridian holds. For Meridian Corporation, owning 30% of Acme Incorporated, it must recognize 30% of Acme's profits or losses, directly impacting its income statement. This recognition is key to reflecting true financial performance. A frequent pitfall is miscalculating this share due to improperly applying the ownership percentage. ASC mandates strict adherence to this proportion, ensuring financial statements mirror the economic reality. When Meridian Corporation receives $1 million in dividends from Acme Incorporated, it must reduce its investment's carrying value by this amount to avoid double counting. This adjustment prevents inflating income artificially. The common mistake of misclassifying dividends as income instead of investment adjustment is costly. ASC specifies dividends should reduce the carrying amount, preserving the integrity of financial reporting. Evaluating impairment is crucial for Meridian Corporation's investment in Acme Incorporated. If its fair value drops below the $9 million carrying value, impairment must be recognized, impacting the balance sheet. Ignoring impairment cues leads to overstated assets, misleading stakeholders. ASC underscores the necessity of regular impairment checks, ensuring investments reflect current market realities, safeguarding financial statement accuracy. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 323 offers flexibility with methods like fair value or equity, but mandates transparency through specific disclosures. Understanding both is crucial to presenting an accurate financial picture. When a company gains significant influence, ASC 323 requires recognizing the investment at acquisition cost. This includes transaction costs like legal fees. The critical date? The transaction date when control shifts. For instance, holding 22% of another company's shares usually suggests significant influence, thus activating the equity method. After initial recognition, the equity method adjusts for the investor's share of earnings. If Company A holds a 25% stake in Company B, and B reports $1 million in profits, A adjusts its investment by $250,000. Dividends reduce this amount. Opting for fair value, then remeasure each reporting period, impacting your earnings directly. In financial statements, investments under ASC 323 typically appear as non-current assets. On the balance sheet, you'll see investment in associates for equity method holdings. Dividends received are part of profit and loss, affecting net income. Detailed notes reveal investment nature and ownership, providing context for analysts. ASC 323 mandates disclosing investment nature, revealing strategic intent. A $5 million stake in a tech startup might signal growth ambitions. Investee financials offer insight into earnings potential, while ownership percentage clarifies control level. Disclosing impairments like a $1 million write-down highlights risks impacting stability. Picture a CFO at XYZ Limited acquiring 30% of ABC Corporation for $10 million. With significant influence, they apply the equity method. ABC's $3 million profit means a $900,000 adjustment for XYZ. Disclosures follow, detailing the $10 million investment, strategic reasons, and ABC's financial health to keep stakeholders informed. Meridian Corporation, a global manufacturing company, acquires a 30% stake in an associate for $1,200,000. This triggers the equity method under ASC 323. Explore how Meridian recognizes this investment and tracks changes in the associate's equity. Understand the financial impacts throughout. Recognizing the initial investment is pivotal, as it sets the foundation for using the equity method. ASC 323 mandates this treatment when significant influence is established. Meridian debits investment in associate and credits cash, reflecting its substantial $1,200,000 commitment. This impacts the balance sheet by increasing assets without affecting liabilities. Under ASC 323, Meridian must record its share of the associate's profits, enhancing the investment's book value. The $90,000 credit to equity and earnings of associate acknowledges income on the income statement, boosting net income. Meanwhile, the debit increases investment in associate, signaling asset growth. Dividend receipts reduce the carrying amount of the investment under ASC 323. This $30,000 cash inflow, though beneficial, decreases investment in associate. This mirrors actual cash distribution versus equity earnings. The dividend impacts cash flow positively, while maintaining the income statement unaffected, adhering to equity method principles. Under ASC 323, impairments must be recognized when the investment's fair value significantly declines. Recording a $50,000 impairment reflects prudent financial stewardship. The loss impacts the income statement, reducing net income while adjusting the investment's book value, signaling potential reassessment of the associate's prospects. ASC 323 requires the recognition of losses, similar to profits. Meridian records a $40,000 loss, reducing both income and the investment's carrying value. This entry underscores the equity method's symmetry, reflecting both gains and setbacks in the associate's performance, ensuring comprehensive financial transparency. Selling 10% of the investment stake aligns with ASC 323's derecognition guidance. The $500,000 inflow increases cash while reducing the investment's carrying value. This strategic partial sale demonstrates liquidity enhancement and portfolio rebalancing, impacting both the balance sheet and cash flow positively. Derecognizing the remaining investment closes the chapter on Meridian's associate involvement. The $700,000 proceeds finalize the investment's life cycle, removing its carrying value from the balance sheet. This exit strategy aligns with ASC 323, ensuring accurate reflection of economic reality in financial statements. Every Big Four and investment bank interview on ASC 323 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Significant influence means having the power to participate in financial and operating policy decisions. Typically, it's presumed at 20 to 50% ownership. It's crucial as it dictates equity method accounting, affecting how investments are recorded. A common error is confusing it with control, which involves majority ownership or voting rights. Remember, influence isn't control, but participation. The equity method reflects an investor's share of the investee's net income and equity changes, aligning with significant influence. It ensures financial statements are more representative of real economic interest. A typical mistake is applying the cost method instead, which doesn't reflect ongoing changes. Think of it as capturing the dynamic relationship with the investee. Under the equity method, dividends reduce the carrying amount of the investment, as they are returns of investment, not income. ASC 323 requires this approach to reflect true economic interest. A common error is recording dividends as income, failing to differentiate between profit distribution and capital return. Keep in mind dividends decrease investment value. ASC 323 and Indian Accounting Standard both use the equity method for significant influence, but differ in impairment testing and disclosure requirements. Indian Accounting Standard demands more frequent impairment assessments and comprehensive disclosures. A pitfall is assuming identical treatment, leading to non-compliance. Understand the nuanced differences, especially in impairment and disclosure standards. Under ASC 323, impairment loss occurs when the investment's fair value falls below its carrying amount and is not recoverable. This loss is recognized in net income, reducing investment value. A common error is neglecting regular impairment tests, which may lead to misstated financials. Regularly assess investment value against fair value indicators. With 25% ownership, the company applies the equity method due to presumed significant influence. They adjust the investment account for their share of investees' income and dividends. A common error is failing to adjust retained earnings accordingly. Remember, adjustments mirror the investee's performance, reflecting the economic relationship accurately. ASC 323 and International Financial Reporting Standards both use the equity method, but differ in impairment guidance and disclosures. International Financial Reporting Standards involves more rigorous impairment testing and detailed disclosures. The trap is not recognizing these differences, leading to potential compliance issues. Grasp the nuances in impairment and disclosure to ensure adherence to both frameworks. Under ASC 323, less than 20% ownership typically means no significant influence, so the cost method is used. The trap is misapplying the equity method, which overstates influence and affects financials. Recognizing scope limits prevents misstatement. Always assess influence, not just ownership percentage, when determining accounting approach. ASC 323 mandates disclosures on investees' financial results affecting investors' statements, differences in accounting policies, and any impairment losses. Omitting these details misleads stakeholders, a critical error. Ensure transparency by detailing significant influence factors, results impact, and accounting policy differences. Remember, disclosures reveal the depth of economic ties. ASC 323 deals with equity investments where significant influence exists, typically between 20% and 50% ownership. It covers common and preferred stock, excluding trading securities. The standard guides accounting for joint ventures and excludes partnerships where the equity method doesn't fit. Understanding the scope, definitions, and exclusions is crucial for applying this standard accurately. Keep in mind, the level of influence determines applicability, not just ownership percentage. Under the equity method, investments are initially recognized at cost, including direct costs. The carrying amount is adjusted for the investor's share of profits or losses. Dividends reduce this carrying value. Impairment testing is necessary when there's a decline in value, and losses are limited to the investment amount, unless obligations exist. These rules ensure a fair representation of the investor's financial position. In interviews, understand common traps like misclassifying investments and errors in income adjustments. ASC 323 differs from International Financial Reporting Standards as it doesn't mandate fair value unless impaired. Disclosures must cover the investment nature and earnings share. Stay vigilant with impairment tests to avoid misstated accounts. Remember, ownership isn't the sole influence indicator, and joint ventures need careful evaluation. Master these to stand out in discussions. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.